Alright guys, my name is Shervin, welcome to my channel. In this video, we're going to talk about the best Canadian growth ETFs that you can invest into today. Now, if you've already watched my video on the best growth index funds, I explained how a lot of different index funds use the S&P 500 in order to get a good amount of exposure into the US market and provide the investors with a good index. But whereas the ETFs that we looked at in that video were US-based ETFs, today we're going to take a look at the Canadian-based ETFs that also provide you a good exposure into the US market by tracking the S&P 500. So as a Canadian investor, these are the best growth ETFs that you can invest into with Canadian dollars instead of having to convert your Canadian dollars into US dollars first and then using that in order to invest into the US-based ETFs that pretty much tracks the same stuff anyways. So if you watch till the end of this video, you're going to find out what these ETFs are, what the differences are between them, and which one you should be investing into in order to have a widely diversified and safe portfolio. And all that I ask for in return is that if you enjoy this video, make sure to smash the like button down below for the YouTube algorithm. Now, the first one is called VFV and is put together by one of the most reliable financial companies when it comes to index funds, and that is Vanguard. Now, VFV essentially tracks the S&P 500, which is basically the top 500 companies within the US market. But one of the great features of this index fund is that despite being a growth index fund that focuses mostly on giving you more and more growth on your investments, it also provides you a slight bit of dividend with 1.24% a year. Now, this ETF also comes with a 0.09% management expense ratio, which means that your dividend is actually going to be about 1.15% per year. But frankly, that doesn't really matter that much because at the end of the day, we're investing into this ETF for the incredible growth that we're going to experience on our assets value instead of receiving dividends month to month. Now, there's one important thing that you should know about VFV, and that is that even though you buy this ETF with Canadian dollars, it actually tracks the S&P 500 using US dollars. And I will explain what that means and why this is so important in just a second. But first, let's move on to the next ETF. Now, the next ETF is also put together by Vanguard, and this one is called VSP. Now, VSP also tracks the S&P 500 just like VFV, and it also provides you a slight bit of dividend on top of that in the form of 1.16% a year. And again, similar to VFV, it also comes with a 0.09% management expense ratio, which means that your net dividend yield is about 1.07% a year. Now, you're probably wondering, well, what's the difference between VFV and VSP? They're both tracking the same thing. It's just that one pays a little bit less dividends than the other one. So what really is the difference here? Well, the real difference is that VSP, which you also buy with Canadian dollars, actually tracks the S&P 500 also using Canadian dollars. Whereas with VFV, they track the S&P 500 using US dollars. Now, at first glance, this might not seem like a big deal because at the end of the day, what does it matter what currency we're using in order to track the S&P 500? But really, it does end up making a big difference when the US dollar and the Canadian dollar start outperforming each other. For example, as of recording this, each US dollar is worth about 1.26 Canadian dollars. Now, if you invest into both of these ETFs today, and let's say 5 years from now, you want to sell both of them, and when you're selling, again, each US dollar is worth 1.26 Canadian dollars, then they are both going to be worth the same amount. However, if in the meantime, let's say the US dollar heavily outperforms the Canadian dollar, and by the time you want to sell, let's say each US dollar is worth 1.4 Canadian dollars, then all of a sudden your VFV investments are going to be worth a lot more than your VSP investments, because not only have they grown with the market, they have also grown with the US dollar against your VSP. And of course, on the other hand, if the Canadian dollar heavily outperforms the US dollar in the meantime, and let's say by the time you want to sell, each US dollar is worth only 1 Canadian dollar and nothing more, then all of a sudden your VSP investments are going to be worth a lot more than your VFV investments, because not only have they grown with the US market, but they've also grown with the Canadian dollar against the US dollar. So what does this mean for you as an investor? Well, it essentially means that if you believe that in the long term, the US dollar is going to outperform the Canadian dollar, then you should go with VFV. And if you for some reason believe that the Canadian dollar is going to outperform the US dollar in the long term, then you should go with VSP. But really, the best approach is to just get an equal amount of both and just hold them so that no matter what happens, you have all your bases covered. Now, last but not least, we have ZUE, which is an ETF put together by BMO, which also tracks all the holdings within the S&P 500 to the same ratio, but it doesn't officially track the S&P 500. Now, the reason why they don't officially track the S&P 500 is to avoid paying all the licensing fees that comes with using the term S&P 500 within your marketing, within your expense reports, within your performance reports, etc. So this means that even though you're getting pretty much the same index as VSP, because ZUE is also hedged against the Canadian dollar, you're essentially getting a little bit more when it comes to your dividends because ZUE doesn't have to pay all those expense fees that comes with using the term S&P 500. So as such, ZUE provides you a 1.35% dividend rate, and it still has the same 0.09% management expense ratio, which means that you're still receiving a net dividend yield that is much higher than VSP in 1.24% a year. So really, ZUE is a better alternative compared to VSP because even though it does the exact same thing, it gives you a little bit more kickback when it comes to dividends because of how it avoids paying all those expense fees. So really, the smartest investment would be to put an equal amount into VFV and ZUE and then just let them build for the long term. And then this way, no matter what happens with either currency, whether the US dollar outperforms the Canadian dollar or the Canadian dollar outperforms the US dollar, you still have all your bases covered. Now, I should also mention that when it comes to investing into these ETFs, it's best to keep them outside of your government-registered tax-sheltered accounts. This means you don't want to put them in your TFSA, you don't want to put them in your RRSP, you just want to keep them in a normal investment account where you are not tax sheltered. Now, the reason for this is that you don't have to pay any taxes on the value of your assets going up. You only have to pay taxes on when you sell your assets or when you receive dividends. Now, it is true that with these ETFs, you're still receiving about 1% worth of dividends every year, but that's nowhere near what a lot of other dividend investments will give you on a yearly basis. For example, if you've watched my video on the best Canadian ETFs, I walk you through a bunch of different ETFs that are safe and reliable investments that also give you about 3 to 4% worth of dividends every single year. And when it comes to your tax-sheltered government-registered accounts like the TFSA or the RRSP, you want to save their contribution room for those type of ETFs that give you high dividend yield. So just save those contribution rooms for those other ETFs that give you a high dividend yield, and then use your normal investing account to invest into these ETFs that we went over today. Now, it is true that this means that you have to eventually pay capital gains tax on these investments when you end up selling them later down the line, but it is a lot better to just pay that off later down the line than to have to pay for every single dividend that you receive with your high dividend ETFs. So just keep that in mind and make sure you're investing into each of your assets in the right account so that you don't end up hindering the performance of your assets. Alright, so that's about it for this video. Hopefully you guys enjoyed that. Now, if you haven't subscribed to my channel yet, make sure to smash the subscribe button down below and join the community. I make 3 new videos a week on personal finance and investing, and by subscribing to the channel, you get to see all my new videos right as it comes out. Also, if you have any questions about any of the stuff that we talked about today, make sure to let me know in the comment sections down below where I always answer every single question that comes in. Alright, so that's about it, and as always, thank you so much for watching, and I will catch you in the next video. Cheers.